let's take the discussion forward with Nandan Chakraborty, Head Strategy at DAM Capital Advisors. Nandan, afternoon. Thank you so much for your time. We've connected with you after a very long time, so you should write your strategy notes a little more often, but very nice and detailed one. Let's start our discussion from the header. You put a bird on the one side and a roaring tiger on the other. You're making a case that it's a roaring bull run, but yet not in a bubble zone. How do you substantiate that argument?
So basically, this tiger bird, tries to pick morsels from the open mouth of the tiger. So it has to be very, very judicious to be able to pick these morsels before the tiger's mouth closes. So the entire strategy report is about, boss, it's a bull market. By the way, this is true for thousands of years. The tiger bird and the tiger, which share the same skin color, have the synergistic relationship of basically picking the tiger's tooth after a meal. So this entire report is essentially that, if there is a raging bull market on, it's still not a bubble, then where is a safety where you hide, where you can still pick some good stocks? So I think that's the overall tiger bird strategy. This happens every 10, 20 years, the same thing happens. So it's not some new strategy. It is the way, markets work. So what we've tried to say is the near-term indicators, what to look for now in terms of the direction of the market is fourfold. One is where are FPI flows. So that depends on two factors. One is what's happening in the Fed rate. And the Fed rate, I think, from what we know yesterday, is that things are pretty stable now. And sometime by next year is when we expect the easing to start. The other part of FI inflows is China. So China has long-term problems that we all know, whether it's debt, whether it's demographics, whether it's property and so on. But the short-term problems are all self-goals, which can reverse anytime. So at least in the short term, one must be very, antenna up in terms of what happens in China. So that's one part, which is the FPI flows. The second part, which is the SIP inflows. So SIPs, 1 year return, if it is decent, there's no great problem to SIPs. And SIPs today are roughly 45% of mutual fund inflows, and they are 2 times the net MF inflows. So they are at $100 billion out of $270 billion of MF inflows. They are a huge component, but they are so small in size per SIP that unless the 1 year return is sort of coming down, I don't think there's too much of a worry in terms of SIP, but still we keep a track. Every month we figure out whether there's been any slowdown in SIP or not. The third is El Nino. I think the fears have receded now. What the IMD is saying is that, the exit of the rains will be delayed, and we will take care of most of the rain in September. Therefore, El Nino has faded for now. And, the problems in terms of the Rabi crop, also in terms of water reservoirs being low, hopefully will be taken care of. The fourth is the results of the 4 major elections, state elections. Now, how that will affect your fiscal deficit, because if there's competitive doleouts, then the center will also have to come in and do some competitive doleouts or something like that. So I think these are the near-term market indicators. The market is obviously, we are the most expensive market in the world right now among all the major markets. So that I don't think there's any contradiction over. Mid-caps obviously are overvalued. If you look at a price to book, then the average is about minus 20% is the discount that the average mid-cap 150 has to this thing. Today you're at plus. So you're at way above this thing. Overvaluation in terms of mid-caps. But having said that, I don't think there's any great danger to mid-caps in terms of crashing. What will happen is over a period of time, as now large caps take off, mid caps will come back sometime later, because the FY25 earnings shows a great premium in terms of earning growth over the Nifty. So it will take time. It will take some rest now. Pause. Also, the quality of mid caps that are in the institutional portfolio is not too bad. If you look at institutional funds which are in mid-cap funds, and you look at the top, say, 10, 15 stocks, they're fairly decent. So most of the bubble seems to be in PMS and retail, and which are huge. So if you look at the overall markets, from about 550 odd, 530 odd $1 billion is FII money. 270 each is your retail including PMS and mutual funds, and 230 is insurance.
Nandan,
So you
let
can
me
see
interrupt you over there for a moment before we go into stocks. I want to, you've made two lists. I want to just, talk about two lists of stock. You made a list of large to mid, or largish mid caps, which have the potential to double the EBITDA over the next 3 years. And they are very large liquid names. You're saying they're potential doublers. Can you talk about some of the stocks over there? Very high quality names I see there, while we run them as graphics as well.
So, our compliance doesn't allow me to talk stock specifics. So I will just talk in general. Is that, when mid caps are overvalued, it's no point, haath upar karke saying that mid caps are overvalued and run out of there. Obviously, our job as strategists is to basically give, where can you hide if some sector is overvalued. So that is the intent of that. What we've done is basically say that this 11 players, which are, cricket or football team, whatever you call it. So the types of stocks which have an EBITDA doubling, and for financials we've taken PPOP. So you take where our analysts think that over the next 3 years, EBITDA CAGR is minimum 26%, which is a doubling in 3 years, and where the near-term target price is not negative and the PE is not going to derate. So, which is why we have this list of 11 stocks, which you can show because it's already in a released report. And don't read too much into the fact that a lot of them are into cyclicals, which is banking and financials and auto, because it's just a bottom-up exercise. That's the way it has just come out.
There is also a large cap list which you've come out with, where valuations, you're saying valuations are good and the earnings growth, the visibility of earnings growth is quite reasonable.
So those are more near-term oriented list, which is basically saying that these are among the large caps, which are the ones where show a near-term, upside. There again, you'll find a lot of them are financials, and a couple of them auto, and there's one stock which is Apollo Hospitals there, which is the only outlier. So again, it is not, when you're picking stocks on a bottom-up basis, you're not really talking of any sector preferences. So you will see that financials continues to be a flavor, except the fact that most large funds are already up to their up till here in terms of the large caps. So people will start going down and down in terms of PSU banks, in terms of the smaller mid-cap names in financials and so on. So those will continue to be the flavor. So financials, capital goods, these are the way the flows have been happening, and they will continue to be so. Whereas commodities are sort of easing off a bit now.
One last word I want to understand from you on that point, whether it's a pivot or it is a kind of a pause. A few months back, market thought that it is a pivot, not a pause, and interest rate related, or the beneficiaries of rates topping out started rallying very hard. After last night's commentary from Fed, it clearly appears that there are one or more rate hikes which are there in the offing. How long could the pause be? It is too early. Has the market negotiated that fact fully right now, or not yet?
Yeah, I think so. I think so. It's more or less negotiated that now. So I think markets are now waiting for signs from the economy to have any more this thing on the Fed rate hike.
What are the risks to the earnings momentum of corporate India? Up till now, the corporate profitability is gradually going higher. It has been improving at every market cap and most sectors, right? Apart, of course, some of them. But margin expansion has largely been the story. The way commodity complex has rebounded in the last a month or two, do you think that trajectory could be at risk, the earnings trajectory or margin trajectory?
See, in the mid caps, it's more of a volume growth story. and a little bit back-ended, it is more FY25 than FY24. In the large caps, it still remains an efficiency story. Not only now, but even over the next 2-3 years, as you know, energy costs come down because of renewables, as the capex builds in, also volume will take a little more time. Right now, consumption is very weak, so we will need some of the signs to come in of consumption. So volume remains a weak area for large caps. It is largely in the mid caps, which is why mid caps have been doing far better. So there are earnings risks in terms of chemicals, in terms of IT, in the near term, in terms of capital goods, and we'll have to see how these are taken care of in the next 12 months.
All right, Nandan, we'll let you go on that one. Thanks so much for joining us on the show today. That was Nandan Chakraborty of DAM Capital.